we start speaking about PVR, let's talk about the macroeconomic conditions of India. India is currently the fastest growing country in the world. It is a favorable investment destination. The inflation in India is under control right now. Good monsoons and low crude oil prices might help in the short term. The Nifty 50 has given around 14.2% CAGR return in the last 5 years. The interest rate has been continuously declining. It has come down to 6.25% now, and the yield on bond is also continuously decreasing. So there has been short-term volatility in the market due to demonetization and Donald Trump election. A lot of money has been pulled out from the Indian markets by the FIIs, but then there has been support from the DII. The Nifty has come down from 8,600 to 8,200, but we believe this is short-term pain and a good buying opportunity in the market.
Coming directly to the industry, we know that the domestic theoretical industry has been going at 9.5% CAGR and is expected to stay at that rate until 2020, and it's going to hit INR 160 billion. These are the major 6 characteristics that we see in this industry, which we'll talk about. So, despite everything, the screen penetration in India remains low at only 6 screens per million, and industry has also seen consolidation since 2010, wherein the 70% of the market share today in multiplex industry is controlled by 4 players: PVR, Inox, Carnival and Cinepolis. Moving on, ancillary revenue streams have already grown big time over the years. We have seen 32%, from 32% it has reached 40% in 2016, and the segment itself is going to stay at about 26 billion INR by 2020. And retrofitting is going to be the next big thing in the industry, wherein we convert one single screen into multiple screens, and that can add up to 15 billion INR to the segment. Now the average ticket price over the years have gone up by 4.5 times in India, owing to good technological interventions wherein we have in-app payments and online bookings, and similarly furthermore it is going to give 10 to 15% additional stuff. And in the competitive landscape, if we compare globally, PVR has done well compared to the global competitors. It has the highest occupancy, second highest actually, and the lowest cost of content. So moving on, what we have done is we have analyzed it on IBAS framework, wherein we have taken parameters like F&B spending, technology and in-ad revenue, where PVR holds 35% market share only with 7% screens. So if we see strategic assets, they hold maximum number of screens in the country today at 557, and also the revenue composition is more a well mix of ticket prices as well as the other stuff, ads and F&B. Moving on, we have a direct head-to-head comparison with Inox, and the numbers speak for themselves.
So PVR, it is currently the largest entertainment company in India. It controls around 25% of market share. The major revenue for PVR is the box office collection, which is around 53% of the revenue, the F&B revenue, which is around 25%, and the advertisement revenue, which is around 11%. So the business strategy for PVR has been location drives growth. So they have occupied the best location in most of the cities, in the best of the malls around. So if you look at the occupancy level of PVR, it is higher as compared to Inox, and they have a higher occupancy in South India. So currently they have 24% of the screens of the total screens in South India, and they plan it to increase it to 33%. So why we believe that PVR can have higher profitability compared to its competitors, because content cost is low in India. It is around 45% of the net ticket price compared to 53 to 60% overall, like in other countries. Higher occupancy, as we have already seen, compared to all global competitors, and the model law. So this will allow PVR to have shows 24/7, the law which has been passed by the government. So the revenue growth is skewed towards ancillary revenues. We have seen a strong growth in the F&B revenues and the advertisement revenues, whereas F&B has 50% contribution margin and advertisement has 80% contribution margin. So this will help improve the margins for PVR.
For valuation, these are the 3 methods which we have used, that is discounted cash flow, trading comparables and transaction comparables. Even in DCF, we have gone for 2 models, that is Gordon growth model as well as exit multiple. The weightage for DCF is the highest because that gives us the intrinsic value of the share and hence is most valuable for valuation. Considering all these methods, we have arrived at the price per share of 1,306. Moving further, through the football field, we have analyzed that this will be the price per share for PVR. Also, if we move ahead, we will see that for trading comparables, PVR is already ahead of its peer companies, but still we believe that the price for PVR will increase in the coming future. For trading comparables, the criteria for selecting the companies have been the operations of that particular company, the revenue margins, as well as the EBITDA and EBIT margins. The models used is EV by revenue and EV by EBITDA. For transaction comparables, again the model used has been the operations of the target company as well as the revenue margins and the EBITDA margins for PVR. And this is the value which we are getting, that is 990. Moving further, for WACC calculation, the risk-free rate is the 10-year government bond yield. For cost of debt, we have used a couple of methods, that is the synthetic rating method. PVR has a rating of AA minus and hence commands a 1% premium over the risk-free rate, whereas the second method which we have used is the historical cost of debt, wherein we have analyzed the past year trends of interest given by PVR. Moving further, the beta has been calculated using the slope method. For the discounted cash flow, this is the Gordon growth model. Moving further through the Gordon growth model, we arrive at a value of 1,389. Then when we go for the next method, this is the sensitivity analysis wherein we have obtained the range of 1,296 to 1,500. Also using the exit multiple, we believe that after a period of 5 years, when the investors will exit, the multiple will be 12.5 EV by EBITDA and the valuation will be 1,378. The most important thing which we have kept in mind for DCF is the revenue projections. The segmentation is sale of product, service as well as other operating income, and these are the parameters which we have projected for the DCF, that is the percentage growth in number of screens, the percentage growth in the patrons, the percentage growth in the F&B sector. For sale of product, majorly it is F&B. For sale of services, mostly it is income from tickets, income from selling the licensing rights and bowling. And herein for the first 5 to 6 years we have kept high growth rates, but then later on we have tapered it down to the economic indicators growth rate and also the revenue projections for operating income. In the initial stages, these growth rates are going to be extremely high because these are the new avenues increased, but then later on they will be tapered down to the normal growth levels. This is the income statement which we have projected based on our revenue projections. And hence we recommend a buy rating for PVR and because of the upside potential of 15.4% which we strongly believe to be. Thank you.
Okay, now for the risks. These are the major operational risks. Of this, the important one is the alternate film delivery methods. Currently, there has been a huge growth in online streaming, and this has the potential to disrupt the entire industry. These are the market risks. Of this, there is a risk of foreign competitors entering the markets who have deep pockets and they can start offering competitive prices. The next is information technology risks, key personal risks and other risks. Of this, IT risk is comparatively significant because there is a risk of IT failure. This is what the company is doing to mitigate the risks, and of this, investment in technology, enhancing customer experience and maintaining cash reserves are important. Monte Carlo simulation has indicated a very high probability of a price above our recommended buy price. And for judging the quality of earnings, we have used greatness score and forensic scores, and both of these have indicated very favorable ones for PVR.
So coming to the financial performance, if we see in last 5 years, very strong revenue growth and profit margins are also improving on the back of decreasing COGS and the aggressive capital allocation done by the top management. If we see EBITDA margin is continuously improving and so is the net profit margin, while the COGS has considerably reduced on the F&B. If we see one of the most important thing, the retained earnings for last 5 years, that is 2011 to 16, they have used 74% of the retained earnings for the acquisitions. That is driving the growth for the next 5 years also. And historically, PVR is trading at the 42 price to earning multiple, and that is justified because the EPS growth is highest for the PVR, which is 38%, and while if we see the DuPont analysis, the ROE has increased from 10% to 13%, the major driver being the asset turnover, which is continuously improving and expected to improve further. So expecting the financial performance to keep the pace with the growth for next 5 years, we are giving the buy recommendation. We have also done the on-ground side.
I think the first slide was on macro. You have 10 minutes to cover up, these are what, 40 slides?
Yeah.
So what was the driving force behind giving a GAN on macro?
So like.
It is the last slide only, sir. This is the last slide.
No, the first slide.
So the major reason was that we follow a framework wherein we start off with economy, industry, and then the business. So macroeconomics, like as we've already seen, that demonetization, US elections.
No. Yeah, so
Yeah.
what was, your brief was to talk about stock.
Yes. So,
Right, and-
yeah, the whole idea was to show how, like, in what position we are right now, how India is performing right now, and how the stock market will be impacted. So the fixed income market and the stock market performance, so that we can see that this is a favorable investment destination for our investors.
Also, we believe that economic indicators of any country play a very important role in analyzing the behavior of a particular stocks. Hence, we believe that we should go for the analysis.
Two questions. One, actually a clarification. You mentioned the food revenues are going to go up, right? Or it's going to go down.
It's going to go up.
In one of the slides, your food court revenues are showing negative trend. Why is that? Can you put that slide, please?
Was it at the end of the PPT?
No
Go to the valuation.
revenue projections.
Go back. Yeah, one second. Yeah, this one.
Okay, so talking about this food court income, which it is declining because now they are shifting from, they have originally outsourced their food, like the F&B part, to some other company. So now they are trying it to build it in-house. So that is why this is declining, because it's the food court income which they used to generate from the outsourced business of theirs. But now as they are having it in-house, so in the services part, in the product part, it is actually increasing. Only the food court income is decreasing, where now they are not going to outsource it anymore. Like in the next couple of years, they are going to have it
So
in-house.
where is secondary revenue in your analysis?
It's in the slide.
One slide back.
Yeah, F&B, the F&B spend.
Okay, this is in-house F&B.
Yes.
So that is a transition phase and hence the
Yes.
losses.
Okay.
The location is one of the major competitive factors here. Now 74% of your capex is going into the acquisitions of locations. So is it not going to put pressure going forward on margins, and because it will be rarer and rarer locations? And
So sir, what we did was that first of all, according to our survey also, we seen that location is the major factor, and we've seen that major cities in India still continue to attract majority of the people, and also location itself, what we have seen has attracted more people in the big cities, even though tier 2 and tier 3 continue to boom, and even though they're going to put pressure on the margins, but in the long term, pricing ability has been one of the key strengths for PVR, which we have seen is currently at 185, 10% higher than Inox, 2.5 times the single screens, and still they continue to lead the market.
So they already have allocated 74% of it, of the profits for acquisitions, and they have performed pretty well in the last 5 years. So we already seen the performance even after the acquisition, the DT acquisition.
Yeah.
So we believe that they can sustain this model of theirs when they acquire more and they try to improve their margins by other factors.
In 2015, there is a slight dip in the margins, but that is like in 2015 they have acquired a huge amount of screens.
Yeah.
But in 16 we have seen the uptrend.
And the entire box office was impacted in 2015. So it's not only about PVR, it's about other cinemas as well.
These properties are on lease,
Yes.
Yeah, they are not outright purchases, What is the average length of leases? Because when they come for renewal, there will again be, pressures.
So when we spoke to the management, we had a conference call this one. They said that they have a lease of 10 years, which is pretty long. And they mentioned that in most of the cases they maintain a lease of 10 years wherever it's possible.
In terms of the valuation of the stock is trading at historically high multiples compared to its past,
Yes.
and also compared to the market, it's at a very high premium. So why do you think that is justified? Because if you look at return ratios, they are not very different from where the market is, maybe a couple of percentage points higher. In terms of growth rate, again, broadly towards the upper category of companies which are growing today in the market. So why should they get 40 multiple or 40 plus multiple?
So if we compare this with Inox, so PVR is trading at 42x multiple from the last 7 to 8 years, whereas Inox is trading at 40x P from the last 7 to 8 years. So even the investors believe that PVR deserves a premium over Inox. So now, we already seen that the revenue growth is shifting towards ancillary revenues for PVR, which has a very high contribution margin. It is a market leader, and even our survey shows that PVR is one of the most attractive cinemas. It is more attractive compared to Inox. So the performance of PVR justifies a premium, and
Investors believe in the growth story of the multiplex industry.
And it has the highest EPS growth, which is 38% compared to all the global competitors, and it has the highest ROC as well. So it is much better in performance. Performance-wise, also it is better compared to Inox, and that is why it is trading at a 42x P multiple compared to that 40 of Inox.
In past, it has the 100 P multiple also. If we see the historical P multiple,
which both the companies have. Actually, Inox has also touched 100 P multiple, but right now we believe that it is trading fairly compared to Inox, and it is a good buying opportunity here.
Just continuation of Harsha's question. Your answer all along was comparison with Inox,
Yes.
right? And that investors in the past paid 100 PE multiple, right? So, you are here to give your independent valuation and not be guided by the market intelligence, right? So, the question is, why do you think that 40x is justifiable? Secondly, your benchmark is not, Inox is not a benchmark, right? Right? So, why compare it with Inox?
This factor only we have given a 80% weightage to the intrinsic value of the share, which we have calculated based on our revenue projections. Also talking about F&B, earlier they used to outsource it to others, but then taking further, they will be inhibiting that particular thing within their own ambit, and hence we believe that, and also the acquisition spree which PVR is having, we believe that the addition to the number of screens of PVR, the occupancy levels is definitely going to increase, and hence we believe that PVR deserves a higher valuation, not because Inox is
Even if
not.
you see the valuation, we have given 40% weightage to the exit multiple and 40% weightage to the Gordon growth method. So 80% of the valuation is the intrinsic value, the DCF, and the DCF is much higher compared to the stock price currently. So even our valuation justifies why PVR should be a buy rating as compared to then a sell or a hold. So our valuation in fact justifies that PVR should be a buy, even if it is trading at a higher P multiple.
so P multiple is just to support the analysis. It is not the base of our analysis.
Our analysis is based on the DCF which we perform.
She said that occupancy levels are expected to go up, but your slides don't show that.
Yeah, it is 35% assumed. For the conservative purpose, we have assumed it 35%.
Yeah, so
The argument for higher multiple, according to her, if she wants to answer, she can answer it.
can we answer?
Yeah, my question is, you are saying that higher PE multiple is justified because we expect occupancy rates will go up along with many other issues, okay? So my question is only on the occupancy rate. If it is so, then it's not showing in your presentation.
Yeah, so we have adjusted the occupancy because of demonetization for only 1 year, and then for just to keep it a little conservative.
So for
we have kept it
2017, we have predicted that the occupancy level will.
It's not going up, it's flat.
Yeah, it's flat, but it is higher compared to the average from the last 3 years.
35% is flat, it's not going up. So that is not an argument, right?
For 2017,
Just to keep a valuation a little conservative, we have kept the occupancy level constant at 35%, though they are planning to increase their like number of screens in South, so the occupancy level should ideally increase, but to keep it conservative, we have kept it at 35% because there are a lot of other issues, a lot of